All right. Today is Sunday, the 14th of July, and this is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Before we begin, of course, let's address the breaking news that we got over the weekend. It is a national tragedy, of course. We all watched with great concern about where we're going from here. But it felt as a moment that was bound to come, as if this tension, this divide, this hatred, this insane political polarization has come to a simmering and boiling point, and it just reached climax at that point when former President Trump was almost assassinated on stage, live in front of the eyes of everybody. We all have seen the pictures, and these pictures are going to live in American history forever. And folks are going to learn about them in the history books and in schools, in colleges for years to come. This is not a new phenomenon in American history. We've had presidents being assassinated from Lincoln to JFK, many attempts on political figures, whether we're talking about RFK, Martin Luther King, or Roosevelt, or the numerous politicians that came under attack before. We've seen it in the global stage. Recently, the Prime Minister of Slovakia came under an assassination attempt. We know what happened with former Japanese Prime Minister Shinzo Abe. Everybody's involved in the political game knows that it's a nasty game. It's a risky and dangerous place to be. Whether you're the president, the prime minister, senator, congressman, congresswoman, governor, Federal Reserve chairman, it doesn't matter. You're always going to come under the most intense scrutiny and criticism, and sometimes it gets really, really nasty. Everybody involved in the game knows the stake, but there is a red line, which is violence. Never the answer. And unfortunately, I was yesterday, once I saw the news, of course, there was an initial reaction, and it was a negative reaction, as if, okay, this is what they've been saying all along, and now it happened, it's their fault. But then as I was scrolling through social media, the rhetoric was absolutely ugly, whether we're talking about conspiracies, whether we're talking about blaming right away, and just ugliness all along, and I had to shut it off. And I realized that this moment right now, we have to recognize three things. Number one, we should all be thankful that the former president was not successfully assassinated. It was really close. The term divine intervention, the term incredibly lucky come to mind. Just millimeters away, and he would have been gone right now. And we would have been talking about something entirely different at this point. So number two, we should all be thankful, not just because the former president dodged a bullet, but all of us dodged a bullet, because had he been assassinated, the term civil war would have come to mind. We could have seen a lot of political violence in this country. This is a heavily armed country, and it could easily spiral into a civil war. So I am thankful for that. Number three, we should all be thankful that we got to a point where all of the political tension and polarization boiled up and ended up to this, where all of us, doesn't matter where you fall in the political spectrum, can recognize and say that that's wrong. We can all unite under the fact that what happened was wrong and it's never the answer. Now folks, there'll be a time for the blame game. There'll be a time for the conspiracy theories. There'll be a time for all of this, and you'll see it all over the media, all over social media. But for now, I want to keep it at these 3 points. That I'm thankful that the former president dodged a bullet. I'm thankful that the nation dodged a major bullet. I'm thankful that at least we can use this moment to unite for, let's say, a day or two before we go back to where we belong in the political spectrum. Now, let's talk about the implications of what happened over the weekend on the elections and how that's going to implicate the stock market, the economy. Of course, it is no surprise to anyone right now that the odds for a Trump presidency are incredibly high. I would say the consensus right now that Donald Trump will be elected president comes November. President Biden right now pretty much has no chance. He gave it a last shot this week during the NATO summit. They gave him a press conference. He tried really hard to convey the image that he still got it and the debate was the exception. But he also slipped here and there, calling his vice president Trump and then confusing Zelensky with Putin. So that's what's going to stick with everybody who watched all of that. And now, since we have an assassination attempt on Trump, it pretty much eliminates any possibility of Biden being president. And whether the Democratic Party is going to replace Biden or not replace Biden, at the end of the day, right now, as we speak, the odds we're going to have a Trump presidency. The immediate impact in the stock market and the economy, of course, the stock of DJT, the Donald Trump media, will catch a major bid upon the open Monday. A lot of folks will continue to buy the stock based on empathy to show support to the former president. So that's number one. Number two, the market will now begin to factor in a Trump presidency. What does that mean? Does that mean lower rates as the president perhaps adds more pressure on the Federal Reserve to reduce rates? Or will it be higher rates in the bond market because of the former president's tariff policy? Likewise, we know that the former president prefers a stronger dollar than a weaker dollar. So we should see an impact right there. Number three, I told you before, folks, that the stock market doesn't care whether it's a Democrat or a Republican. At the end of the day, they know the stock market will be the number one benefactor of each party. It doesn't matter. All of them look at the stock market as a barometer for success. What the stock market doesn't like is uncertainty. And right now, the market might sense that we have some uncertainty. We just talked about Donald Trump, of course, being reelected here. Pretty much it. But can we guarantee that we're not going to have another attempt? What's going to happen with the Democratic ticket? What kind of twists and turns to this story that we still have before the elections? I think the market will begin to price at least some degree of uncertainty. But folks, we can talk about this and a lot more in the next few days. In this video, I want to talk about the important phenomenon that we got in the stock market this week. As the title implicates, this week, the week that was, we got perhaps the most bullish day in the stock market year to date. But during this most bullish day, stock market indices were actually down. You need to understand why and where do we go from here? Because in last weekend's video, we talked about how the week that was will dictate the future of Biden, the future of the rate policy, the future of the market rally, the future of other assets such as Bitcoin. And we pretty much sealed the deal on all of these things. And we've seen the phenomenon of the rotation based on higher odds of a rate cut. Now, we've seen this phenomenon happening back during the fourth quarter of last year, specifically in December, where we got a favorable CPI reading, inflation reading. And every time we get those, the market immediately assumes that the worst is behind and now we have to rotate because interest rate cuts are more likely than not. But in each attempt in the past, and we talked about this in numerous videos in December, we suggested some rotation plays in portfolios. Some would be transitory, some would be not. But it's a play that could be really lucrative in the meantime. We also called it the light at the end of the tunnel syndrome, seeing the possibility of rate cuts with nothing bad happening to the economy. But usually, historically speaking, the light at the end of the tunnel ends up being an incoming train. Why? Because we go back to a phenomenon that we talked about in this show numerous times. A lot of folks did not understand it back then, but you're probably going to begin to see it right now. It's called the duality of the risk. That interest rate cuts after a hiking cycle happen as a response to weakening in the economy, otherwise known as recessionary factors beginning to show up in the economy. The Federal Reserve, historically speaking, doesn't cut rates for the good reasons in the economy. It only happened once in 2018, 2019. But they usually cut rates when something bad happens to the economy. And this is why we said before in another video, be careful what you wish for. You might get the rate cuts, but it might happen for the wrong reasons. And there is another risk, by the way, that if rate cuts happen without the ultimate and the certain defeat of inflation, it might revive inflation again and cause more chaos. In the meantime, if the market realizes that the promise of rate cuts right now more solid than December and than before, there could be a lucrative trade called the rotation trade. So we're going to talk about this and the risks and a lot more in this video. Without further ado, folks, let's dive right into it by identifying what was the problem with this market. We all know that the criticism behind this rally, which a lot of folks dub as a bull market or one of the greatest market rallies in history and all of that. But the criticism from folks like me was, but this rally has been going on based on incredibly bad breadth, meaning that we have a handful of stocks, heavyweights, that are rallying higher because of the AI mania and because of the passive investing bubble mania. And those handful of names managed to push the indices higher. But when you open the hood, and you diagnose the market, you will see that the majority of stocks are either lagging or actually going down. So can we really call it a bull market or a healthy market rally when we only have a handful of names that are moving the indices higher? Of course, I leave the answer to you. Everybody has an opinion. Some folks say, Well, that's what really matters in the economy. Others would disagree and say, no, the fact that we have the heavyweight names going higher, but the rest of the market going down is a sign of concern. Here's the illustration for you. When we look at the composite, this is the NASDAQ composite. We see that during this rally, more stocks in the NASDAQ hit new lows versus new highs. We've only seen this before at this magnitude right before the implosion of the dot-com bubble. The other problem, of course, is the top 10 companies in market cap been leading the S&P 500 higher, but their contribution to earnings didn't improve that much. And this was part of the concern that we just have a multiple expansion mania, but not based on merit and significant improvement in earnings. Another problem in the market, of course, is the over-concentration. And we know when we have over-concentration, it is happening at the index level, meaning the concentration is happening in these handful of stocks that happen to be the largest market caps in the market right now. Households, the allocation to stocks is at incredibly high levels. We've never seen these levels before, besides the height of the dot-com bubble, when households and retail investors become excited about the stock market. When we look at asset managers, they're also all in, fully invested, 98%. When we say heavy invested, again, they're in the ETF level, meaning in the same heavyweight stocks, the over-concentrated stocks. We've seen this kind of positioning at these absurd levels before major corrections, bear market crashes, as the chart suggests right here. Furthermore, we see a lot of amateur hands taking a lot of risk in the market. Another attribute of bubbles and mania episodes in the market before. When we look at the share of Americans under 25 who own stocks, we're now at the highest concentration in history, higher than the height of the dot-com bubble. The problem is that the investors, specifically under 25, what are they buying? They're buying the same handful of names that are really over-concentrated right now. So, for example, there are the buyers of the recent dip in NVIDIA. And the other sign of concern, of course, is from the other side, the naysayers about this rally, also known as the bears. Most of them already capitulated. Most of them already got their pink slips. The latest, of course, the last bear on Wall Street was Marko Kolanovic. He got his pink slips recently. This is kind of a concerning sentiment. And of course, when you hear professional shorts in former bubbles who made their name from shorting these bubbles, for example, the big short investor Steve Eisman, when they talk about what's going on right now and describe shorting the market as insanity, that's also a source of concern. But it also illustrates the over-concentration in the market. Why is it insanity? Because you're betting on those handful of names. You're betting on the bubble to deflate. You cannot bet against the index right now without being 100% sure that the over-concentration bubble is over. And furthermore, not over for a good reason, but over for the bad reason. What are we talking about? That leads us to the fix. This week, we got the CPI reading, the inflation report for the month of June. And this is the first time when we get a negative month-on-month inflation reading since the year 2020. We had low numbers before. We even had a zero reading before. And every time we see these kind of low readings, the market immediately assumes that the risk from monetary tightening is over and behind us. And we gravitate toward rotations into growth and profitless stocks. What is different about this one than the past episodes? Well, this one was the only negative reading month-on-month since 2020. So it increases the odds for a rate cut, meaning that this rotation is more solid than previous ones that we've seen in the last 2 years. And when we talk about the fix, we showed you this before. The SPX in white, this is the S&P 500, and then you have the IWM, the small caps in blue, and the RSP in orange, which is the equal weight S&P 500. While the index been rallying higher based on the backs of handful of names, mega cap stocks, based on the AI mania, such as NVIDIA, and the passive investment mania, such as Apple, Microsoft, and other big caps. The equal weight index and small caps lag, and usually recoveries in the economy are led by smaller caps and the equal weight index. Go back to 2020 and 2009. Recoveries are always led by small caps and the equal weight index, but not the recovery that began in the year 23. It was based on the mega cap stocks, while the small cap and the equal weight lagged. This week, we have seen the opposite. The index lagged and actually went down on Thursday, while the equal weight index and the small caps rallied significantly. And this is why I called it the most bullish day in the year. Yet the major index was trading negatively. And this is something you have to understand, because right now, a lot of folks will talk about the light at the end of the tunnel again, that we're having interest rate cuts for the good reasons, and the market breadth is now improving. But you have to be aware about the obstacles ahead. You see, we have three phases in monetary cycles: rate hikes, rate pauses, also known as a hold, and then we have rate cuts. When we talk about rate hikes, it is one of the most challenging periods in stock market investing. It favors either defensive stocks, inflation stocks, or both, depending on the economic cycle. On the other hand, growth stocks become the worst performers. We've seen that in the year 22. For example, the energy stocks rallied. On the other hand, we've seen small caps and technology stocks, also known as growth stocks, underperforming. What about the pause? The pause is one of the best periods in stock market investing because of optimism about upcoming rate cuts. It stops the bleeding in growth stocks, whether we're talking about small caps or technology stocks, and the money flows into large cap stocks because during the pause, you still have higher rates, which adds a lot of pressure on the economy. Maybe we see the light at the end of the tunnel, but in the meantime, with higher rates, either you're going to go with fixed income to capture the higher rate, money market funds, or you invest on the index level because you have the largest cap stocks with the best cash positioning. Those are usually the ones that benefit from higher rates. The only stocks that really benefit from higher rates because they have a lot of cash. They can get yield based on that cash. And the result, of course, major indices outperform. And we've seen this in the year 23 all the way to 24 so far. Major indices rallying higher based on a handful of stocks, which happen to be the mega cap stocks. And this is why we say if you happen to be bullish in the stock market, you better hope that the pause period never ends. Because once we segue to the rate cut period, there's the misunderstanding among investors that this will actually be good for the stock market. But here's what usually happens. We have to assess during a rate cut phase. Do we have no risk? Do we have a recession risk or an inflation risk? We have no risk, such as 2018, 2019, when the Fed backed off from interest rate hikes and decided to cut rates. We've seen a major rally, rotation favoring growth stocks. Now, the problem that we see here, the difference between now and 18, 19, is the fact that the index back then was not as over-concentrated as we see right now, meaning a rotation from mega-cap stocks to smaller, growthier stocks in late 2018, early 2019 didn't really hammer the index level. We've seen both of them actually rallying higher together, and 19 was a phenomenal year. The problem that we have right now, the over-concentration in the mega-cap stocks is severe. It's even bigger than the peak of the dot-com bubble. For example, Nvidia. The market cap of this company right now, which has been leading the market rally pretty much single-handedly, the market cap of this company is the equivalent of 11.7% of the entire GDP of the nation. At the height of the dot-com bubble, Cisco was the leader of the market and the poster boy of the bubble. But Cisco at the height, the market cap of that company was only 5.5% of GDP, meaning that if we have a rotation right now for names like Nvidia into smaller cap names or lagging stocks under the hike and the pause periods, the outflows from names like Nvidia, even when we have no risk, a rotation for the good reasons, let's say it shaves off 10%, 20% off Nvidia to free up capital so that we can rotate the other names. This drop in a name like this that is so big relative to the economy and the entire value of the market will drop the indexes down, even though you'll see the breadth improving. Other stocks, smaller cap stocks, gaining from this rotation, but their gains will pale in comparison, and it will not make up to the deflation in the value of these names that went significantly higher during the pause period. The mega cap stocks, the AI mania stocks, led by Nvidia. If you noticed during last weekend's video, I pinned a comment by the viewer, and this was the most common question, let's say Monday, Tuesday before the CPI, as if folks already knew what's going to happen. The most common question was, hey Maverick, what if the IWM and small cap stocks begin to catch a bid? Wouldn't that lead the market to rally higher? And I said the problem is if we catch a bid in smaller caps via a rotation from the mega caps, the major indices will actually go down, because the entirety of the Russell 2000 is valued at $2 trillion. Names like Nvidia alone is valued at $3 trillion, along with Apple, Microsoft, Google, Meta. When you add the valuation of all of these companies, we're talking about $6 trillion plus. If there's a correction in these names worth 10, 20% because of rotation, it doesn't matter what kind of gains you're going to have in smaller caps. It will never make up for the reduction in value in a $6 trillion plus valuation. I said during the week, we have created a monster in Nvidia. Because if Nvidia goes down, specifically for the wrong reasons, it doesn't matter what goes higher. Small caps, mid caps, Dow Jones names, energy stocks, doesn't matter. Nothing is big enough to make up from the deflation in market cap value in Nvidia. We have created a monster, and now we have to live with it. Too big to fail. What happens if we have rate cuts, but we do have a recession risk? you will see an inclusive rotation in the beginning, as we've seen this week. But the rotation is going to frizzle out. It's only going to last and be sustained in bonds and the US dollar. That's the worst outcome, of course, because what happens later on is the Fed continues to cut rates even more. So they cut by 25, then they cut by 50, then 75, because they're trying to stop a bleeding in the economy. And investors panic and they say, okay, we read it wrong. We shouldn't be rotating to small caps. We should actually be rotating the bonds and the US dollar. And case in point, of course, late 2008, 2009. Do we have any signs that this could be the case? Yes, because we've been in a stagflation phenomenon in the economy. Look at the recent warnings from companies that reported earnings, like Delta, for example, warning about profits. Traffic is good, but they cannot make a profit. At the moment we see unemployment rising higher and traffic goes down, you think they're going to make more profits then when they can't do it right now? That's a major problem. PepsiCo warned about U.S. demand weakening. Before that, we talked about Helen of Troy with major warning about the consumer. Lululemon before that, Nike, Chipotle, all of these companies warned about weakening in the U.S. consumer. Furthermore, when we talk about the recession risk, we got earnings from large banks. We see delinquency rates moving higher. We see loans marked as unrecoverable also rising at larger banks, never mind the smaller ones. We've seen the unemployment rate rising higher in the latest payrolls report. Don't forget that we also have the revisions that we keep getting. The government gives us a number. Oh, we created 200,000 jobs, 100,000 jobs, and then they revise it lower later on when nobody's paying attention. Recently, of course, we were all stunned by the fact that California overestimated its jobs tremendously, as you can see from this chart right here. And in reality, we only got about 10%, if not even less, from the jobs numbers that California told us they've created during the year 2023. So we know that we have warning signs that the recession risk is actually real in this economy. We've gotten before favorable, let's say friendly CPI readings. The Fed did not cut rates. It was only a tease. In December, we got a friendly CPI reading. Mr. Powell came out at the podium and said, yeah, we see rate cuts coming. I'm going to promise you right now, but we see them coming. We're on the right track here for rate cuts. The market priced in a rate cut as soon as March of this year, and it never happened. Of course, this CPI reading makes the case better for rate cuts. But let's be honest here. Why is the Federal Reserve really, if they are going to cut rates, why are they going to cut rates? Is it because CPI went down to negative month on month? Of course not. They're going to cut rates because we're having deterioration in the economy. It's becoming clear that the U.S. consumer is becoming weaker and weaker and weaker. It's becoming clear that we're beginning to lose jobs in this economy. That's why the Federal Reserve is cutting rates. That takes us to the third risk, the inflation risk. If that is the case, then of course we'll get an inclusive rotation in the beginning, as we get always. But which ones will be sustainable? The answer is commodities rotations. Let's assess the risk of inflation, or let's say re-inflation in the economy if the Fed cuts rates. The Fed wants to cut rates to save the economy from unemployment wave that's to come, meaning that the Fed is looking to loosen financial conditions by cutting rates. Well, as we know right now, financial conditions right now, as we stand, the easiest in 27 years. What happens when you loosen financial conditions that are already loose? Historically speaking, we get a revival of inflation. Here's another illustration for you from the Goldman Sachs index. You can see that financial conditions right now looser than the year 23, looser than 22, looser than even 21. So, okay, the Fed is going to loosen financial conditions even more, risking the revival of inflation. Is there a real risk in reviving inflation when we have a CPI that went negative month on month? Of course. Just look at the commodities, what's going on in energy pricing right now. The WTI is not at $60 a barrel. It's not even at 70. It's in the 80s. And in the latest PPI report, also known as the Wholesales Price Index, it actually came out hotter than expectations. It went higher. And the most important finding is this. The reading is an increase from the May number, which was also revised higher. Friday's report said that the index was unchanged in May as compared to a decline of 0.2% in the original release. So not only they're revising the unemployment rate higher and they're reducing the number of jobs being created after the fact, they're also revising inflation data higher after the fact. So folks, is the recession risk real? Yes, it is. Is the inflation risk real? If we cut rates, the answer is yes. So you have to be aware of those. I'm not saying don't go with the rotation right now. Don't make money right now with the trade that we got. You should do that. You should play the game that you got right now, but be aware of what could happen later. Here's what happened back in 2007. September 2007, the Fed cuts rates. Initial reaction by the market is it goes higher. But if we plug in the chart of crude oil in orange, Look at what happened when the Fed cut rates. We've seen a rally in oil, reinflation, and the Federal Reserve responded by pausing rates in the year 2008, specifically April 2008. And there was talk about hiking rates again. That kind of chaos marked the end of the stock market rally, marked the end of the economic cycle. With that understanding out of the way, do we have a rotation right now? Yes, we do. Can we play it? Yes, we can. I'll show you which rotations you can play with, but you have to keep these obstacles and these degrees of risks in the back of your head when you choose where you're going to rotate to, because not all rotations are created equal. Not all rotations are sustainable. They might actually fade by this week, but we go back to the big caps again. If we get a piece of data that suggests, nope, we're not going to cut rates, we're going to keep it as it is. Or we could get more recession data or more inflation data, and then the rotations frizzle from certain corners and stay in others. So again, every rotation has a degree of quality. Some low, some high. But we know right now the rotation trade is out of the big caps, out of what's been working, the AI mania, the mega cap mania, the Ozempic mania. But we're going into dollar-sensitive rotations, yield-sensitive rotations. We talked about this on Thursday's video, but I want to expand on that a little more. And folks, before the rotation even began, I issued a morning brief to my members in Discord. And I said, look, we're going to see a rotation based on the CPI reading, and here's how you're going to play it. And I gave details. You can pause and read this morning brief for yourself. But in a nutshell, as you can see immediately after the CPI, the NASDAQ, the S&P 500 been outperforming the Dow Jones. But once we got the rotation after the CPI, the Dow Jones took leadership. And of course, with it, the IWM. So when we look at the rotation, we have 5 rotations we can follow. I'm expanding the conversation right now from Thursday's conversation. We have the index rotation out of the S&P 500 and the NASDAQ into the Dow Jones and the Russell 2000. But we also have a rotation into profitless stocks. If rates are going to go down, then we're going to alleviate the pressure of higher rates from profitless stocks. And we have different categories when we talk about profitless stocks. We have small caps, biotech, we have zombie companies, we have solar companies, we have EV companies, we have IPOs. Another rotation is the dividend stocks. Right now, dividend stocks not doing so hot, so because why would I take the risk when I can get 5% plus parking my cash in a money market fund or in a fixed income? But now if you're going to reduce the rate on those fixed income instruments, then dividend stocks become more attractive again. And those can be divided into staples, consumer defensives, utilities stocks, healthcare stocks, real estate stocks, and telecom. Another rotation, of course, in the dollar-sensitive cohort. Dollar-sensitive meaning if we're going to cut rates, we're easing financial conditions, we're devaluing the dollar. As the dollar goes down, what appreciates? Gold and silver, metals, grains, energy, multinational companies, industrial companies, international companies. And the last rotation is the yield-sensitive rotation. If we're going to cut rates, then bond yields go down. That's going to be good for home builders, construction stocks, banks, autos, retailers, and bonds. Sure, the yield on bonds will go down, but the value of bonds goes higher. I will show you what I like right now or what I don't like in each category. This is my sentiment right now, and it could change based on the data that we get. But I look at these rotations as opportunities to get long in some names, but also to short some names. So if there are names that I didn't like before, and I think that rate cuts will happen for the wrong reasons, or will cause inflation again, then I'll look at certain rotations as opportunities to short. They're giving me opportunities to short at a better price. So for now, we'll look at profitless stocks. We'll look at small caps. I like the Russell mid-cap stocks, the IWS, over the IWM and even the IWN. The IWM, the reason is it has a lot of zombie companies. And if we're cutting rates for the wrong reasons, then that's not going to help these zombie companies. The IWM is full of profitless companies. The IWS actually has companies with profits. Likewise, if we're cutting rates and then causing inflation again, then we're going to stop interest rate cuts. They might not even happen to begin with, and the rotation into the IWM frizzles away. But the IWS has components that will still do pretty good even if rates stay as it is or go higher. The IWN is the Russell 2000 value. The problem with this ETF is it is heavy in home builders. And if I have a bearish view in home builders, then I don't want to be there, and I have my own thesis on why I don't want to be in home builders at this point. And the other problem with IWM, the highest weighted stock is super micro. And we know if there is a rotation out of NVIDIA and NVIDIA goes down or the AI mania frizzles, then super micro will get hit. So how would that help the IWM? And this is why in the small caps rotation, mid caps rotation, I'm more of an IWS guy over IWM and IWN. When it comes to biotech, I do like Moderna. Sure, the level of profitability is the problem, but it's getting more and more contracts from the government, the bird flu and such. Regeneron, I do like that too. I've been owning Regeneron for a long time. It's a high-quality biotech company, and it will benefit more if we ease the interest rate policy. What I don't like in biotech is the XBI, the ETF, and the reason is it's heavily weighted in Novo Nordisk, which is the Ozempic mania. And if we're going to rotate out of these names, then do I really want to be in the biotech ETF when the heaviest weighted name experiences outflows? What if we cut rates for the wrong reasons? Do I really want to be in the profitless biotech companies? Not really. Then what about the zombie companies? We have a lot of zombie companies, over 700 zombie companies in the market right now. I'm just giving you examples here of names that I'm already short, and I will look at the pops as opportunities to short even more. Names like Mattel, Dave & Buster, Denny's, and we have many more zombie companies. I don't trust the rotation in these names. I think they're not going to be lasting, and therefore I'm only looking at them as, okay, you're going to give me a better price to enter a short. Likewise, when it comes to solar, profitless companies like Sunrun, Solar Edge, they're going to catch a bid. But then we're going to realize that maybe rate cuts happening for the wrong reasons. There's a recession or causing a revival in inflation. I don't want to be in these guys. I'm just looking at them as an opportunity to short at some point. When it comes to the EV component, sure, we have a massive rally in Lucid and Rivian. We get all of that. They're profitless, they have problems, so of course they benefit when rates go down. As the assumption is, oh, we're going to see a revival of buying EVs. I think this assumption is misplaced because the consumer is getting weaker. And giving us a 25 basis points rate cut is not going to really revive the demand for these expensive vehicles. The folks are finding out that once you buy them, you're sitting on negative equity anyways. But I do like the fact of the devaluation of the dollar that causes lithium stocks and battery stocks to go higher. So I do like QuantumScape and Albemarle, ALB. Now, when it comes to the IPOs, of course, it's going to benefit initially. It's going to benefit names like Reddit and many of the IPOs that we have. Once we realize that we're doing rotation for the wrong reasons, I think they're going to go down. So I'm looking at the recent pop in IPOs as an opportunity to short at some point, not right now. You don't want to stand in front of the tsunami of the rotation. But once you get more economic data pointing out that, wait a minute, rotation's happening or rate cut optimism happening for the wrong reasons, aka a recession, or causing a revival in inflation, or you want to short these pops right away. What about the dividend stocks? Maverick likes in staples, I do like tobacco and alcohol, habit-related kind of staples. Philip Morris, British American Tobacco, Constellation Brands, and Kroger, of course, benefits when you give the consumer a little bit of an ease to go to the grocery shop. What doesn't benefit are the companies that already warned us. Hey, folks, the consumer is pulling back. We're seeing reduction in volume, meaning we have to reduce our pricing. Okay, if you're going to reduce pricing, would that bring the consumer back to consume more? There's no guarantee in that. And at the same time, with energy costs still sticking higher, there's no relief from the cost side for these companies. The only avenue for them is to let go of employees. So we'll see more and more layoffs in these food companies, and that's going to increase the unemployment rate. So do I really want to be in PepsiCo or Kellogg's or even General Mills or Utz? Maybe at some point when the recession actually officially happens. But right now, with the weakness in the consumer, I want to avoid those and stick with companies that have the sustainability of a habit, such as tobacco and alcohol. When we look at dividend-paying stocks, utilities I do like, so the XLU, especially if the economy weakens, you want to be in because rate cuts driving bond yields down, and utilities will give you a nice dividend. The consumer is not going to cut spending on utilities. They have to pay the bills. So usually these defensive utilities do pretty good when the economy begins to weaken. Now, real estate, the IYR, catches a bit, of course, initially. But I think that we're getting rate cuts for the wrong reasons. So I want to look at the pops in the IYR as an opportunity to short later on. In healthcare, I do like healthcare. It works either way, recession, no recession. Stagflation, inflation, doesn't matter. But I do like the dividend-paying stocks in pharmaceuticals such as Amgen, AbbVie, Merck, even Pfizer might begin to outperform right now. Of course, every time it does, it fades away, but maybe this one is the real one here. Gilead is good, Abbott, even Johnson & Johnson been a laggard, but now dividend-paying stocks with yields coming down, and it's a defensive stock, could catch a bid. Medtronic. So you have a lot of names in healthcare, not just these. Any dividend-paying name in healthcare, specifically the defensive ones, will be a good pick at this point. Telecoms I do like, Comcast, Verizon, AT&T. They're kind of utilities anyways. Maybe Comcast is the weaker name here, but you got to pay the bills anyways, and they pay you good dividends, so we'll see inflows into these names. What about the dollar-sensitive rotations? I do like a lot of those because the dollar going down, you're probably not going to see a bid to the dollar until we get an actual crash or recession. So there's more sustainability in this rotation than the others. So I do like gold and silver. I do like metals, copper, Freeport McMoran, or the SLX, the steel ETF. But you have to be careful. If we get more recession data, it could hit those names specifically. So gold and silver, stronger than the metals rotation. We have grains, of course, benefit when the dollar goes down based on rate cuts. So you got names like John Deere, Nutrien, the fertilizer names, Mosaic, Corteva, the pesticides names, all good. But again, once you get recession news, you have to be careful because the allure is being taken out of these names. When we look at multinational industrials, I like the laggards, the dividend-paying names, the good valuation names. I think we see rotations into those, like 3M and Honeywell. I don't like what's been working. The names that were involved in the inflow mania or the construction mania, like GE, like Caterpillar, like Eaton, and even the entirety of the XLI. I'd like to be really, really picky when it comes to the industrial rotation. Then what about internationals? I do like Chinese equities right now. I've been saying this for a while. So FXI, KWEB, even individual names like Alibaba or JD, the emerging market ETF, EEM, and the Brazilian ETF, the laggard EWZ, all of them will benefit if the dollar continues to underperform. Now, the dollar is oversold right now. We're probably going to see a rebound based on what happened over the weekend, the political chaos. But if this rotation sticks and nothing really spoils it right now, and the dollar continues to stay low, I think these names will continue to benefit. Lastly, what about the yield-sensitive rotation? We'll look at the home builders. I don't like the actual home builders. The ETF XHB, Lennar, Toll, DR Horton. And I made my case before, folks, that in the year 22, folks talked about a housing recession. And I said, folks, the housing market is not in a recession. We only see recession-like data that activities are plummeting, but the only reason for that is the lack of supply. But as we speak right now, this is again in 22, the companies are building a lot of homes, a lot of apartments, and this supply is going to show up later. In the meantime, as they continue to build these homes, which companies will benefit? The resources, the material kind of names, the roofing, the piping, the flooring, the tools kind of names. A lot of folks didn't talk about this in 22 or even 23. Everybody was just focused on the AI bubble. But I told you folks, there are another bubble going on right now. And in 23, I was heavy in the tools, in flooring and piping and roofing and isolation. All of these names I was long and they benefited from a massive pop. But now I think that we're going to see a phenomenon in the housing market of oversupply versus low demand. You can cut the rates from mortgage rates, that is from 7% to 6%. What is that going to do? Everybody's going to stampede and buy homes all of a sudden? No, we're looking for a reduction in pricing, folks. But we're not going to get that until the recession hits. When it comes to the home builders, Lennar, DR Horton, Toll Brothers, they've assumed all of that cost in buying roofing, piping, lumber, isolation. Now they have to sell these homes at a profit. Well, if we're looking for a deterioration in the economy, will they be able to sell them at a profit? I don't think so. So I'm looking at these pops as an opportunity to short in names like Lennar, DR Horton, Pool, Mohawk, Flooring, even the construction names like the ITB, the construction ETF, Volcon, Martin Marietta, Granger, Masco, Owens Kerning, Hubble, Johnson Control. It kind of hurts because I love these names. At least I used to. They made me a lot of money in 22 and 23. I think they're high quality names, but I think that the bubble in these names will deflate because we're heading into a dynamic of higher supply in the housing market and deteriorating demand. It's going to take a lot of rate cuts to bring demand back. I think by the time we do that, we'll be already in a recession. So when I look at these pops as an opportunity to short, but I do like we can lump them into home builders, Home Depot and Lowe's, because the optimism of lower rates reviving demand could prompt a lot of homeowners to begin doing smaller projects, taking more trips to Home Depot and Lowe's. We made a video before, folks, a stock battle between Home Depot and Lowe's for the members of this channel. I told you that even in a recession, especially when the recession hits, Home Depot and Lowe's recover better than the index and faster because the demand for home improvement actually increases from homeowners who did not get hit by the recession and folks who are looking to flip homes at that point. So I do like those for now, and in that video I told you that Lowe's is the pick over Home Depot for reasons we discussed during that video. And indeed, if you look at the weekly performances here, Lowe's did outperform Home Depot. So we are on the right track. I do like Carrier too because of the heat wave and what's going on right now. You have to think about it this way. When the home builders build new apartments or homes, they spend on roofing, lumber, flooring, all of that happens in the beginning. But at the end, they spend on air conditioning. So for now, if I want to chase anything in the home builder rotation, I will hold my nose and go with Carrier if I must pick, but the others I would look at as an opportunity to short. What about the banks? I do like a rotation in the KRE, and this is why I have a star. But I'm playing it right now. I actually done with most of it on Friday. I think we're a little overbought in the KRE. But my thesis was we see a rotation from the XLF to the KRE. I do like Goldman Sachs too, at least for now, because of the recent rally in the stock market. I don't like the big banks though, the XLF, JP Morgan. And the reason why JP Morgan will probably begin to go down from this point on, they've been a benefactor of higher rates. The net interest income been increasing higher in JP Morgan. If you cut rates, you take that tailwind away from JP Morgan. Wells has other problems. It has the highest exposure to commercial real estate and bad loans among the big banks. And I think at some point that's going to be a problem. So again, I'm looking at any pops in these names as an opportunity to short later on. In the autos, I do like Ford over GM. GM been a benefactor of what's been going on. It's been rallying significantly higher. Ford been the laggard. Ford pays a higher dividend. So for now, I think Ford will catch a tailwind. GM will see outflows. We'll see a shift from GM to Ford, at least in the meantime. Then what about the bonds? If rates are going down, then you should be in the TLT. And I took more risk on Friday by buying the JNK, the junk bond ETF. And let's say, you're crazy, Maverick. All of these junk bonds will explode as the economy hits a recession. Gotcha. That's why I got a star on it. That it's a rent for now, not an actual buy. We're just playing some rotations here. A lot of this stuff is not going to stick. It's actually going to end up in a disaster. But then I look at the retailers, the XRT. Sure, you get a pop in these names. But I'm looking at these pops as an opportunity to short later on. In a nutshell, folks, you have to look at these rotations based on quality and do your own homework. You don't have to listen to this. I could be wrong about a lot of this. But you have to divide these rotations into individual names and individual sectors and ETFs and make up your mind. Which ones do you like right now? Don't just chase because something went higher or somebody said something will go higher. Look into things that you like and you think will benefit at least in the meantime until we get more recessionary data or a revival in inflation. And you think these rotations of higher quality. Now, before we wrap it up, folks, you have to understand that we talked about a lot of market dynamics here. So I don't want to waste your time with a lot of market information at this point. I want to look at the charts and what you really need to know about the charts and then wrap it up. Let's begin with SPY, the S&P 500. What do we see here? On the hourly chart, we see a positive divergence in the chart, but then you look at the indicators, the RSI and the MACD, we see a negative divergence, meaning that the wave wants to correct. In other words, the best in this move higher is already behind us. The move higher that began, of course, in the beginning of the month. And we're more likely to correct this move than not. Of course, there is a case that we could continue to go higher, which is what if this is a cup and handle? But it is imperative that tomorrow we see a stop with the declines that we've seen late Friday. Otherwise, I think that we're going to continue to correct here and make lower lows. Looking at the daily chart, the SPY. Do we have a bearish engulfing candle? Yes, we do. And we closed within the body of this bearish engulfing candle. Until we close above it, we don't have a reversal yet. And the predominant theme remains the bearish engulfing candle. Okay, if this is going to lead to a correction here in the SPY, how far can we go? We go back to the trend line. And that will be just a garden variety correction back to a trend line. Nothing really changes here in terms of the weekly chart. So if we look at the weekly chart, overextended, it is due for a correction. The problem that I see, and I highlighted this throughout the week, if you look at the weekly RSI, we are way overextended. And in the past, we've seen these kind of readings. We've either had crashes, as you see in volume getting in 2018, the pandemic crash in 2020, or the correction that we got earlier in the year, 2024. We're not in good company. The other thing you want to look at in the weekly RSI, you see what's been happening since the bottom in 22. We've been doing higher lows and higher highs. If that begins to reverse and gives us the look that we've seen in the aftermath of volume getting, of lower lows and lower highs, then that's going to be the top of the market right there. Looking at the daily chart for the E-mini futures and the S&P 500, again, every time we get to the top of the Bollinger Bands, we either have consolidation that leads to higher highs, or we have consolidation that leads to corrections, and we've seen that twice this year, one of course being more aggressive than the other. So all what we know right now is we stall, and we're either going to stall for a little while, gather the energy to pop higher. I think that's going to be dependent on the earnings season, or we're going to do a correction all the way down to the lower Bollinger Bands, which is due. And again, if we draw a trend line, if you don't like the bands, just do a simple trend line. If we go down the trend, that'll be a correction of about, let's say, 3% or 2.5%, depending on when we get there. On the Qs, what do we see on the hourly chart? looking a lot weaker than the SPY because, of course, the outflows are coming from the mega cap stocks, from the AI mania. So we see that it is showing the correction clearer than the S&P. And it could be a leading indicator for the S&P. Can we finish the move here in an inverse ABC pattern all the way to 487? I think if we still have a rotation into next week, that's going to be the case. Another way we can look at it is perhaps a topping head and shoulder pattern in the hourly. On the daily, what do we see here? Big bearish engulfing candle. We closed within the body of the bearish engulfing candle. If a correction is due, we're probably going to go down to the trend line. If we look at the NASDAQ futures daily chart, the bullish trend that began in, let's say, May, as you can see in the MACD indicator, I'm pointing 1, 2, 3. There was attempt number 1 for a correction, but it was too early. There's attempt number 2. Didn't work out. Third time a charm. And we actually get a correction. If that is the case, how far will we go? Let's draw the trend line once again. You can see that if we go down the trend line right now, it'll be a correction of about 4 to 5%. So again, it'll be a little steeper than the S&P 500. And I think the catalyst, if the correction actually happens, will be coming from earnings. What about the small caps IWM? On the hourly chart, we identified the risk of an inverse and a shoulder. Got a big pop after the CPI. Then we got consolidation of a bull flag, which played higher on Friday. But then on Friday, it seems that we kind of stalled, forming a bear flag pattern. The daily chart, we see that we're way outside of the upper Bollinger Bands, forming an inverse hammer. It is probably a top for now, meaning we get a pullback, but don't bet against the IWM here until you get a piece of data that says, okay, the rotations are happening for the wrong reasons. We get rate cuts because recession is showing up, or we get the rate cuts and then we see inflation going higher. Actually, before getting the rate cuts, the optimism of a rate cut could move crude oil higher. If it does, then the rotation to the IWM will frizzle out. So for now, we're looking for a correction in the IWM, just to pull back here, allowing the bands to catch up with the move, and then we'll see what happens. And by the way, a pullback in the IWM means that probably the KRE is also getting toppy, the XPI getting a little toppy in the short run, the home builders getting a little toppy, so you get the memo. But anyways, these are the major charts that I wanted to share with you tonight. So let's segue to the conclusion of this video. What do we have on the economic calendar comes this week? Monday, July 15th, tomorrow, we have the Empire State Manufacturing Survey, along with another speech from Chairman Powell. So that's going to be a market mover tomorrow. Then Tuesday, the 16th, we have retail sales, really important piece of data. We have the import price index. Then we have the home builder confidence index. This is going to be really important for the recent rallies in the XHB and the ITB, the construction ETF. Comes Wednesday, July 17th, we have more housing data from housing starts and building permits. That comes, of course, on top of industrial production and capacity utilization. And we conclude the day with the Fed Beige Book. Comes Thursday, July 18th, we have initial jobless claims and the Philly Fed Manufacturing Survey. Of course, concluding with U.S. leading economic indicators. Comes Friday, July 19th, we only have speeches from Fed zombies from New York, Williams, and Atlanta, Bostic. Anyhow, we'll be back again tomorrow, folks, with more details and more coverage of the stock market and the economy. So stick with us here, and if you like the show, please help us out by pressing the like button, subscribing, leaving a nice comment, and considering being a member either here on YouTube or Patreon to access the daily coverage and more bonus videos. But with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Rotate, rotate, rotating all day long.
Mm-hmm.